think basically Bitcoin got overbought in March, effectively, and that pulled forward demand. People had very elevated expectations. If you look at like year-to-date returns, Bitcoin's been very strong, even though all of that growth happened between January and March. And it's been consolidating since then. We generally see there's some selling pressure from existing holders. There's buying pressure from ETFs and entities like MicroStrategy. I think we're slowly building out of the space, is my expectation. So if people ask me, do I think it's more likely that Bitcoin breaks out of the space or breaks down from the space? I think it's much more likely that we break out to the upside from this base. Whether it's later this year, depending on election outcomes, I tend to think that we're going to break out of this.
Lyn Alden starts off by examining current patterns in the performance of Bitcoin, emphasizing an important rise in early 2024. She credits this surge to the enthusiasm surrounding Bitcoin ETFs, which increased demand and raised prices. However, a period of consolidation began as the market processed these gains. Lyn is completely excited about Bitcoin's long-term future in spite of these swings. She predicts a possible breakthrough supported by important on-chain measures, maybe later this year. By contrasting Bitcoin's market capitalization with the total cost basis of its holders, one of her favorite tools, the market value to realized value ratio, provides profound insights into the cryptocurrency's valuation. Lyn says that even in times of market decline, this indicator shows the faith and trust of long-term investors. If you're intrigued by Lyn Alden's insights, don't forget to like this video, subscribe to our channel, and turn on notifications for more in-depth discussions on cryptocurrencies and macroeconomic trends. Thank you for watching and enjoy the video.
I think it's because the ETFs pulled forward demand. I think basically Bitcoin got overbought in March, effectively, and that pulled forward demand. People had very elevated expectations. If you look at like year-to-date returns, Bitcoin's been very strong, even though all of that growth happened between January and March, and it's been consolidating since then. We generally see there's some selling pressure from existing holders. There's buying pressure from ETFs and entities like MicroStrategy. I think we're slowly building out of the space, is my expectation. So if people ask me, do I think it's more likely that Bitcoin breaks out of the space or breaks down from the space? I think it's much more likely that we break out to the upside from this base, whether it's later this year, depending on election outcomes, or whether it's 2025. I tend to think that we're going to break out of this. But I think that right now it's a bullish asset. It's just that some of that like artificial demand was pulled forward. And that's one of the biggest headwinds against it. But I think that we've kind of gotten to the point where we worked through that. We kind of worked through some of that accelerated expectations, kind of renormalized. And a key metric that I look at is market value versus realized value. And you can apply that to any asset if you have the data for it, which is to say the market cap compared to what is effectively the on-chain cost basis, or the aggregate dollar value of coins, not based on the last time they moved. And generally, whenever you get a high market value compared to that cost basis, you're more prone to corrections, because some of that inflated value is not real yet. It's not really been actualized and traded around with high volumes at that price. And so even though Bitcoin is roughly priced how it was in 2021, the bullish case is that the cost basis is now much higher. I would argue kind of the floor of how people treat it is higher. So back then, even though the market cap got over $1 trillion in 2021, the on-chain cost basis was something like 350 billion. Whereas now, at the current time, we have a similar market value, but the on-chain cost basis is something approaching 650 billion. So you have that less of like inflated multiple of market value to realized value. And then even in this current period since March, even in this consolidation, the on-chain cost basis has increased from something like 520 billion to 640 plus billion. So I think the floor is kind of keeps elevating, is how I view it. So the short answer is I think that discrepancy is caused by ETFs pulling forward demand, and that I think that we're kind of in a consolidation until we eventually break out. Nothing stops this train. And what I mean by it is that large fiscal deficits in the United States are going to continue for quite a while. They're above average, and there's very little probability of them being meaningfully reduced anytime in the near future. And this has a variety of macroeconomic and investing implications. A lot of investors are very focused on the credit cycle or monetary policy. That's really been the guiding force for developed markets over the past 4 decades. But ever since about 2019, and then especially starting in 2020 with COVID, and in this higher nominal and percentage of GDP fiscal deficit framework, which has been surprising to a lot of investors because a lot of their tools, or a lot of the things that they historically learned to focus on, are actually kind of taking a back seat to the sheer amount of fiscal stimulus and pre-stimulus that's hit the economy on a quarterly basis. And the relevant thing for crypto assets is that basically, the denominator is kind of in a sustained debasement mode, which, to some extent, it always has been. Fiat currency is always weakening. But basically, when you're running these high of structural deficits, that background level of debasement is faster. And so my general argument, like the key thing that I've been focusing on in my investing, is that we're in a hotter nominal GDP and a hotter nominal asset price environment than we would otherwise expect if we were running 3% of GDP deficits rather than 6 or 7% GDP deficits. And I think that investors of all types, whether it's TradFi or in this space, should be mindful of that fiscal impact of the economy, because it's actually a lot more powerful than some of the monetary policy impacts that we historically see.
The next market cycle, according to Lyn Alden, will concentrate on distinguishing between projects that address pressing issues and those that are solely motivated by speculation. According to her, this is a natural progression where the market favors enterprises with lasting sustainability and actual utility over temporary excitement. Lyn highlights that Bitcoin ETFs are inevitable for large and liquid assets. According to her, ETFs serve as a conduit for institutional investors, providing a safe and useful means of making Bitcoin investments. Some people are concerned that ETFs might devalue Bitcoin, but Lyn thinks these worries are unjustified. Rather, she sees their appearance as evidence of Bitcoin's increasing significance and acceptability by the general public. Make sure to hit the subscribe button and turn on notifications to stay updated with our expert analysis. Now, let's get back and hear what Lyn Alden has to say.
Each of those cycles, one was a liquidity cycle. So I've done research showing that the whole space is pretty correlated with measures of global liquidity. So what they tend to have in common, like the 2017 cycle, even earlier cycles, but let's say the last two cycles, 2017 and 2021, they were positive liquidity cycles. But then also there were tech narratives in the space. So whether it's ICOs, DeFi, NFTs, each one had these kind of leading narratives that eventually kind of saturated itself. It kind of hit a peak period of speculation and then eventually kind of subsided and was no longer the main character narrative. So I think whether or not we get a broader rally in the space will partially depend on whether there's a narrative that's similar in scale to those. And at the current time, I don't really see a narrative like that other than maybe real world assets, but that is kind of inherently less speculative in a way. Obviously, people can speculate on which rails will win markets like that, and people can place their bets accordingly. And even, stable coins are a type of real world asset, essentially. It's kind of the original real world asset, is taking $1 and putting it on the blockchain. And so I tend to be focused on those utility questions. And so I probably the people here would be better than me at speculating on the next, say, non-Bitcoin narrative in the broader space. But the thing I would bring from a macro perspective is to say that the monetary and fiscal environment is probably less supportive of speculation in this upcoming cycle, and that it's more differentiating between what is actually solving a problem versus what is not. I step back and say, first of all, it's inevitable. Any asset that gets sufficiently large and liquid is going to have ETFs for it. That's basically like the fiat system's API for plugging into it. That's just how they plug in. And so if any asset can't handle ETFs being made for it, if that's a problem, then that asset was never really useful to begin with. That's a fairly low hurdle rate that an asset has to step over to be globally relevant. So, on average, I view it as a net positive, because it basically just means that there were large pools of capital that wanted to be in, but didn't have a regulatory or functional way to get into the space earlier. And so you had to use inefficient proxies like, Grayscale, where in addition to being prone to the price of the asset, you were also focused on, is the premium going to turn into a discount, or how deep can the discount get? Can the discount ever be resolved with redemptions of any sort? And that of course blew a lot of people up in the past cycle when people were leveraged based on that issue. So you could argue that if spot ETFs came earlier, the last cycle could have been less damaging for people in the space. And then there are pools of capital that, for example, they can't even buy a Bitcoin ETF. They can only buy there are large pools of capital that can only buy stocks, like companies, or can only buy bonds. Right now, the main entity filling that role is MicroStrategy. So if you're a stock, and if you run a stock fund and you happen to be bullish on either Bitcoin or the space, one of the only avenues they can express that view is either the miners or or MicroStrategy. Currently, there's not that many ways for them to express bullishness on the rest of the space. There's not really like that companies that are heavily engaged. Maybe Coinbase is probably the best way they could express that. And then same for bonds. So MicroStrategies, for example, issuing bonds, convertible bonds. So if you happen to be a bond investor that happens to like the space, that's one of the avenues that they can express it. And the high premium to NAV shows that there's a lot of built-up demand among institutions for these types of products. And so when we come back to the spot ETFs, basically there's pent-up demand for these assets, and now that's being met. And there's a centralizing force to some extent, but a lot of it is just rotation. So we've seen, for example, GBTC had over 600,000 coins. That a lot of that drained into the other ETFs. There's now more coins in total in the ETFs than there were in Grayscale, but not by a huge amount. It only went up by a few 100,000 coins, and the price increase associated with that was pretty large. And so, to the extent that you'd get another few 100,000 coins into these entities, it probably would come with pretty big price increases, and therefore it'd be harder for them to kind of capture a very big percentage of the market. So I'm not that concerned about it, even though it's something I'm monitoring. As for how it impacts different assets, I have a little bit more concerns around how large holdings of an asset will impact proof of stake networks versus proof of work networks, but that still remains to be seen. And then it's also possible that because the current regulatory environment doesn't allow staking yields in the ETFs, that could slow down the attractiveness of those products compared to if we get products where the staking yield can be part of the total return environment.
In her concluding remarks, Lyn Alden emphasizes how cryptocurrency markets are cyclical and influenced by changing narratives and liquidity. She points out that previous cycles, such as those in 2017 and 2021, were driven by a wealth of global liquidity and speculative tech themes, like NFTs and DeFi, before waning. These stories reached a saturation point. Lyn expects a more practical cycle in the future, one in which efforts addressing pressing issues take priority over conjecture. It is anticipated that the environment would distinguish between sustainable innovation and ephemeral trends as a result of less favorable fiscal and monetary conditions. According to Lyn, Bitcoin ETFs are essential for big liquid assets because they provide institutional money with a controlled approach to enter the market. Although some people worry that ETFs could consolidate Bitcoin ownership or devalue it, Lyn contends that this is not the case. She sees their debut as evidence of Bitcoin's development and its significance on a worldwide scale. Additionally, ETFs offer a safer substitute for ineffective investment vehicles such as Grayscale, which have historically caused problems for investors. She adds that the large premiums and quick uptake of ETFs demonstrate the pent-up demand for institutional-grade Bitcoin investment solutions. Lyn thinks that ETFs enable wider access to Bitcoin and sustain price increase over time, despite the fact that they introduce some centralization. She ends on a fair note, recognizing the continued development of the cryptocurrency industry while remaining upbeat about Bitcoin's position as a key component of the ecosystem. Thank you for watching, and as always, happy investing.